Hello and good morning, Dr. Aidil. So today our group will be discussing two key question topics. First, we'll evaluate the effectiveness of deposit insurance scheme in preventing bank runs and consider their potential drawbacks. Then we'll compare monetary policy in advanced and emerging economy, highlighting the challenge faced by emerging economy in implementing effective policy. Okay, before we start answering the two key questions, let me introduce our group member, which consists of me, Isma, Irfan, Aridh, Danish, Hassanan, Anis, Aisyah, and Adriana. Okay, here is an overview of our presentation. For question 1, we'll explore the purpose and structure of deposit insurance system, evaluate their effectiveness in preventing bank run, and discuss potential drawback. For question 2, we'll compare monetary policy in advanced and emerging economic and analyze the challenge emerging economic face in implementing effective policy. So let's go with the first question. Okay, let's start with the first question, which is evaluate the effectiveness of deposit insurance scheme in preventing bank run and what are the potential drawbacks. So let's begin with the basic. What is deposit insurance? Deposit insurance is a system set by the government or an independent agency to protect people money in a bank. So if a bank fails, deposit insurance guarantee that depositor will get back their money up to a certain limit. Okay, this gives people peace of mind, especially during uncertain time. So the purpose of deposit insurance is simple. It's to protect depositor saving and build trust in the banking system. So it also helps prevent bank run, where many people withdraw their money at the same time due to a fear. Okay, next I will explain deposit insurance scheme by comparing three systems. Okay, let's start with Perbadanan Insurance Deposit Malaysia, which is PIDM. So PIDM established in 2005 after the Asian financial crisis. PIDM protect deposit up to 250,000 per depositor and per bank. It's not only safeguard depositor but also act as a key pillar in maintaining stability and public confidence in Malaysian banking system. Next is the Federal Deposit Insurance Corporation, FDIC, under the United States. So FDIC established in 1933 after the Great Depression. It protects deposit up to 250,000 and it helping to prevent widespread bank run while serving as a model for other nations in strengthening trust in their financial system. The last one is European Deposit Insurance Scheme, established in 2015 but is still under development. It aims to harmonize deposit insurance across EU nations, protecting deposit up to 100,000 while reducing the reliance on national resources to handle banking crisis. Okay, so now I'm going to explain the effectiveness of deposit insurance in preventing bank run. First is deposit insurance will gain trust in banking system. So why does this matter? So when depositors trust that their money is safe, they are less likely to panic and withdraw their saving all at once. This help prevent a bank run. In Malaysia, Perbadanan Insurance Deposit Malaysia (PIDM) play a key role in building that trust by guarantee deposit up to 250,000 per depositor and per bank. This assurance keep depositor calm even during financial uncertainty. Let's look at an example. During the 2008 global financial crisis, while many countries struggle with panic withdrawal, Malaysian banking system stay resilient because depositors know that their funds were secure. So it will enhance the confidence and reduce the fear and preventing mass withdrawal. This shows how PIDM has not only protected saving but also gained public trust in Malaysian banking system and ensures stability during tough time. Okay, that's all from me. I will pass to Adriana.
Thank you, Isma. So my name is Adriana. Today, I will be talking about the second and the third effectiveness of deposit insurance scheme in preventing banks run with a focus on Malaysia. So the first effectiveness is the prevention of bank runs by assuring the depositors. So one of the most important rules of deposit insurance is to prevent panic-driven withdrawal, which are a primary trigger for a bank's run. In Malaysia, the Padanan Insurance Deposit Malaysia, which is PIDMs, plays a crucial role in this process by guaranteeing deposits up to RM250 per depositor per bank. So, for example, in 2015, when Bank Mutiara, or formerly known as Bank Islam Malaysia, was taken over by a new owner, there was a lot of uncertainty in the market. However, the IDM deposit protection helps reassure depositors that their funds were secure, preventing a potential panic withdrawal. So the second effectiveness is the stabilization of the financial system. Deposit insurance schemes also contribute significantly to the overall stability of the bank system, which is critical in preventing the domino effect that could also result from a bank run. By assuring depositors that their funds are protected, these schemes help prevent panic withdrawal from spreading to other banks. For instance, during 1997 Asian financial crisis, several banks in Malaysia were at risk. However, after the crisis, the establishment of PIDM provided depositors with confidence that their savings were safe up to a certain limit. This protection helps prevent mass withdrawal across the system and avoid further financial instability. Thank you, and now I'll pass to the next.
Hi, I'm Hassanan. Today I'll be talking about the potential drawback of the deposit insurance scheme. While this concept is reassuring, it comes with its own set of challenges. Let's look at it one by one. For bank, deposit insurance can create a moral hazard. Knowing depositors are protected, bank might take riskier steps investing in high-stakes venture or approving loans without due diligence. After all, if things goes wrong, it's the insurance scheme, not the depositor, that bear the initial brunt. This can lead to careless decision making, increasing the likelihood of financial instability. And for the depositor, they might become less vigilant about where they store their money. With deposit insurance in place, their focus may shift away from the bank's financial health, assuming their money is safe no matter what. In severe crisis, deposit insurance fund, normally built from the bank's contribution, can run out if many banks fail simultaneously. Government then step in using the public money to protect depositor. This often means higher tax or cut from other public services, directly impacting citizens. Taxpayer may lose confidence in the system, feeling unfairly burdened by the irresponsible banking practice. Now, consider international banks operating across border. Deposit insurance scheme may vary by country. For instance, Malaysia insure deposit up to 250,000 ringgit, while in the UK is 85,000 pounds. When a multinational bank fail, coordinating between these different schemes is complex. Dispute over who get priority can delay claim resolution, putting depositor in undesired position. Finally, deposit insurance can distort competition. Smaller banks often offer higher interest rate to attract the customer. To keep up, even larger banks might raise their rate, funding them through riskier loan over time. This escalates instability, increasing the likelihood of bank failure. Deposit insurance is essential as it protects depositor and maintain confidence in the financial system. But undertaking its implication is key to addressing the risk it can introduce. Striking a balance between protection and responsibility is crucial for stable financial future.
Hi, my name is Irfan, and I'll be continuing talking about the potential drawbacks of deposit insurance scheme. So operating a deposit insurance scheme is essential for financial stability, but it comes with their own significant costs. First, there are regular assessment of participating banks. These evaluations ensure that each institution is financially sound and compliant with the rules, which require constant monitoring and expert analysis. Next, maintaining a fund to cover potential claims is crucial. This reserve must always be sufficient to handle emergencies like bank failures. Building and sustaining this fund can be costly as it demands contribution from banks and careful investment to keep it growing. Finally, during financial crisis, the scheme must manage claims effectively. This involves processing a large volume of requests quickly and ensuring that depositors regain access to their fund without delay. Each of these operational tasks requires substantial resources, expertise, and coordination, highlighting ongoing financial and logistical burden of running such a system. So while deposit insurance is vital for protecting depositors, it also comes with their own significant risks that need to be addressed. One major concern is the potential for underfunding. If contributions to the insurance fund are set too low or miscalculated, the fund may not have enough reserve to handle a large-scale banking crisis. This lack of preparation could lead to severe financial instability as the fund would struggle to meet the demands of the depositors during a systemic shock. Moreover, rebuilding the fund in the aftermath of a crisis would be a slow and challenging process, especially when public confidence is already shaken. Another critical issue is the encouragement of excessive credit growth. Deposit insurance reduces the fear of deposit losses, which might lead banks to engage in riskier lending practices. This can fuel rapid credit expansion, often contributing to the creation of asset bubbles in areas like real estate or the stock market. When these bubbles eventually burst, they leave behind economic imbalances that are difficult and costly to address.
Hi, I'm Aridh. I'm going to explain how do monetary policies differ between advanced economies and emerging economies. Monetary policy is a cornerstone of economic management, and its priorities and approaches vary significantly between the two of them. In advanced economies, the primary focus of monetary policy is clear: inflation targeting, typically around 2%. Central banks such as the Federal Reserve or the European Central Bank prioritize price stability. This singular focus allows them to implement consistent policies aimed at fostering economic confidence, encouraging investment, and maintaining purchasing power. In contrast, emerging economies must juggle dual objectives: controlling inflation while stabilizing their currency. These economies often face external pressures like volatile capital flows or commodity price fluctuations. Stabilizing their currency becomes critical to prevent devaluation, which could lead to higher import costs and economic instability. However, this dual focus can limit flexibility. For instance, during economic fluctuations, emerging economies may need to prioritize defending their currency over stimulating growth, leading to slower recoveries. Next, advanced economies typically implement counter-cyclical policies, raising interest rates during economic booms to prevent overheating and lowering them during recessions to stimulate growth. This approach helps smooth economic cycles and maintain stability. Central banks in these economies benefit from strong institutions and deep financial market, which enable them to act predictably and effectively. In emerging economies, monetary policy has historically been more pro-cyclical, with central banks tightening monetary conditions during crisis due to fears of capital flight or currency devaluation. However, there is a growing shift toward counter-cyclicality. Improvements in institutional frameworks, inflation targeting policies, and greater financial stability have allowed some emerging economies to adopt counter-cyclical measures, providing more flexibility to respond to economic fluctuations. This shift represents significant progress, but many emerging economies still face structural challenges that limit their ability to fully employ or implement counter-cyclical policies. That's all from me. Thank you.
Building on this discussion, another key difference lies in how this economy handle external shock and the policy mechanism they employ to respond. Advanced economy benefit from relative insulation against external shocks. Their currencies such as US dollar or euro are global reserve, reducing the risk of sudden capital outflows or exchange rate volatility. They are also less dependent on commodity export, minimizing exposure to global price swings. However, advanced economies aren't immune. For instance, the 2008 financial crisis and COVID-19 pandemic causes significant disruptions, prompting central banks to respond with measures like quantitative easings and near-zero interest rates. In contrast, emerging economies face far greater exposure. Commodity price fluctuations can severely affect inflation and growth, especially for nations reliant on raw material exports. Volatile capital flows, often driven by external conditions like US interest rate change, can lead to sharp currency depreciation and financial instability. To address this challenge, both groups rely on distinct intervention strategy, which is advanced economies focus on streamlined set of tools, policy rates and forward guidance to influence markets and expectations. During crisis, they tend to unconventional measures like large-scale asset purchase or negative interest rates. As for emerging economies with greater weaknesses, employ a wider range of measures. Reserve requirement to manage liquidity within their banking systems, foreign exchange intervention to stabilize their currency during capital outflows, capital controls to regulate destabilizing cross-border movement of money. This mechanism reflects the unique challenge each group faces, shaped by their economic structure and exposure to global force.
Hi, I'm Aisyah. I'm going to talk about challenges of emerging economy face in implementing monetary policy. First of all is inflation management. Inflation management refers to the process through which a central bank or monetary authority controls the rate at which the general price of the goods or service in an economy increases over time. The goal is to keep inflation stable and predictable, which is crucial for economic stability and growth. For example is external shocks, demand pull inflation, and cost push inflation. For external shocks such as commodity price shocks, for emerging economy that rely heavily on imports, for essential goods like oil and food, fluctuations in global price can lead a significant inflationary pressure. For example, a rise in oil prices can increase transportation costs and lead to a broader price increase across the economy. Also, global supply chain disruptions, events like natural disaster, pandemics can disturb global supply chains, leading to a shortage of key goods on pushing price higher. Second one is demand pull inflation. When the aggregate demand exceeds aggregate supply, price rise. In the emerging economies, rapid economic growth and or government stimulus can increase demand faster than supply can keep up, leading to the demand inflation. Lastly is cost push inflation. It occurs when the overall price level rise due to the increase in the cost of production, often linked to the factor like higher wages or increased cost of the raw materials and energy. For emerging economies, cost push inflation can be particularly problematic because of their reliance on imports. For example, essential goods, limited domestic production capacity, and external economic factors.
Alright, moving on to the next challenge in implementing effective monetary policies in emerging economies, which is structural economic problems. A large portion of the workforce in emerging economies operates in the informal sector, businesses and jobs that are not registered or taxed. These workers don't typically have access to formal banking or credit systems, so they are not directly affected by changes in monetary policy like adjustments to interest rates. Next, high unemployment rates or underemployment reduce the impact of monetary policies aimed at stimulating demand. For example, lowering interest rates might encourage businesses to borrow and invest, but if unemployment remains high, the resulting economic benefits are limited. Lastly, poverty aggravates this issue because people living in poverty spend most of their income on basic necessities, which are often less sensitive to monetary policy changes. For example, a rise in interest rates may not reduce demand for essential goods like food or electricity, but it can increase borrowing costs for those already struggling. Therefore, structural problems like poverty, unemployment, and a large informal economy weaken the reach of monetary policies, making it harder for governments to achieve broad economic growth or stability. Another major challenge in implementing monetary policies in emerging economies is low central bank credibility. For monetary policies to work effectively, trust in the central bank is critical. In emerging economies, this trust is often fragile due to a history of poor decisions such as uncontrolled inflation or excessive money printing. These actions make people question the bank's ability to manage the economy, leading to a preference for foreign currencies or alternative financial options. When people lack confidence in the central bank, it undermines monetary policies. For example, instead of spending or investing, they may hoard money or demand higher wages, which disrupt economic stability. This makes it much harder for the bank to steer the economy toward growth. Building credibility takes time and consistent action. It requires transparent policies, clear communication, and a commitment to financial stability to win back public trust and ensure monetary policies can make an impact.
That's all from us. Thank you.